Welcome dear audience, students and scholars. Dear scholars, so far as we have developed the IS and LM model, and with the help of IS and LM model we have theoretically and empirically overview the economic fluctuations, and then we have linked the IS and LM model to the Great Depression of 1930s, and we have viewed that how much IS and LM model contribute to the Great Depression of 1930s, and we have concluded that with the help of IS and LM model we can control the coming Great Depression. Here in this video we are going to discuss a case study that is related to the financial crisis and economic downturn of 2008 and 2009. Dear scholars, in year 2008 the US economy experienced a financial crisis. Several of the developments during this time was evident of the even during the 1930s, causing the many observers to fear a severe downturn in economic activity and substantial rise in unemployment. The story of the 2008 crisis. The story of 2008 crisis begins a few years earlier with a substantial boom in the housing market. The boom had several sources. In part, it was fueled by low interest rates, as the Federal Reserve lowered interest rates to historically low levels in the aftermath of the recession of 2001. Low interest rates helped the economy recover, but by making it less expensive to get a mortgage and buy a home, they also contributed to a rise in housing prices. While talking about the story of 2008 crisis, in addition, developments in the mortgage market made it easier for the subprime borrowers, those borrowers with the high risk of default based on their income and credit history, to get mortgages to buy homes. One of these developments was synchronization, the process by which a financial institutions, a mortgage originator, makes loans and then bundles them together into a variety of mortgage-backed securities. These mortgage-backed securities are then sold to other institutions, banks, or insurance companies, which may not fully appreciate the risk they are taking. Some economists blame insufficient regulation for these high-risk loans. Others believe the problem was not too little regulation, but the wrong kind. Some government policy encouraged this high risk lending to make the goal of home ownership more attainable for low income families. Together, these forces drove up housing demand and housing prices. From 1995 to 2006, average housing prices in the United States more than double. The high price of housing, however, proved unsustainable. From 2006 to 2008, housing price nationwide fell about 20%. Such price fluctuation should not necessarily be a problem in a market economy. After all, price movements are how make the market economy to equilibrate the demand and supply. Moreover, the price of housing in 2008 was merely a return to the level that had prevailed in 2004. But in case the price decline led to a series of problematic precautions. So here we have to discuss some of the main repercussions here. The first repercussion here. The first repercussion of the was a substantial rise in mortgage defaults and home foreclosures. During the housing boom, many homeowners had bought their homes with mostly borrowed money and minimal down payments. When housing price declined, these homeowners were underwater. They owned more on their mortgage than their homes were worth. Many of these homeowners stopped paying their loans. The banks servicing the mortgage responded to the default by taking the homes away in foreclosure procedures and then selling them off. The bank's goal was to recoup whatever they could. The increase in number of homes for sale, however, exacerbated the downward spiral of housing price. The second repercussion A second repercussion was large losses at a various financial institutions that owned mortgage-backed securities. In a sense, by borrowing large sums to buy high-risk mortgage, these companies had bet and that housing price would keep rising. When this bet turned bad, they found themselves at or near the point of bankruptcy. Even healthy banks stopped trusting one another and avoided interbank lending, as it was hard to discern which institution would be the next to go out of business. Because of these large losses at financial institutions and widespread fear and distrust, the ability of financial system to make loans even creditworthy customers was imprisoned, impaired. Impaired. Okay, the third repercussion, while talking about the third repercussion, was a substantial rise in stock market volatility. Many companies rely on financial system to get the resources they need for business expansion or to help them manage their short-term cash flows. With the financial system less able to perform its normal operation, the profitability of many companies was called into question because it was hard to know how bad things would get. Stock market volatility reached levels not seen since the 1930s. The high volatility in turn lead to a fourth repercussions, a decline in consumer confidence. In the midst of all the uncertainty, households started putting off spending plans. Expenditure on durable goods in particular plummeted. As a result of all these events, the economy experienced a large contractionary shift in the IS curve. The US government responded vigorously as the crisis unfolded. The first Fed cut its target of the federal funds from 5.25% in September 2007 to about 0% in December 2008. Second, in an even more unusual move in October 2008, Congress appreciated $700 billion for the Treasury to use to rescue the financial system. Much of these funds were used for the equity injections into banks. That is, the Treasury put funds into the banking system, which banks could use to make loans. In exchange for these funds, the US government become a partner for the banks for a temporary basis. The goal for the rescue was to stem the financial crisis on the Wall Street and prevent it from causing a depression on every other street in America. Finally, when Barack Obama became the president in January 2009, one of his first proposals was a major increase in government spending to expand aggregate demand. These policy action would not prove to be enough to prevent a significant downturn in economic activity, but would they be sufficient to prevent the downturn from evolving into another depression? Policymakers were certainly hoping for that to be the case. So this is all about the case study of financial crisis and economic downturn of 2008 and 2009 in the case of US. So see you with another video. Ciao.